What's up, traders? So today I'm going to show you two different stocks that I pretty much always have trades on. And these two stocks collectively help me bring in at minimum $5,000 every single month. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, of course, first things first is I need you to go ahead and smash that like button. That just helps the video get out to as many people as possible. And also do subscribe while you're at it. And do remember that I'm not a financial advisor and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. Now, before we get started, I do have to shout out a member of our community who is absolutely killing it. So my guy here, Leho, he said, Rashad, another fantastic week with cash secured puts and covered calls, collected premiums in TQQQ, UPRO, HIMS, Hood, Tesla, TSLL, Palantir, BITX, MST, and NVDL. Thanks, Rashad. Truly a blessing. And you can see that he collected $6,690 over the past week. Now, beyond that just being extremely amazing, Leho has been in the community, I believe, for about a half a year now. And so I've had several conversations with him. And I do know that he works a full 9-to-5 job. And so my initial reaction when seeing this post was, of course, extreme happiness. And I'm just thankful that God has used me in order to help bless others. But then I started to think back to when I was an employee, because my last time being an employee was in 2017. So I believe I was 28 years old. And just being honest, the most I ever made as an employee was $18 per hour. All right. And now I know that was back in 2017 and some things have changed. So maybe I'd be making a little bit more now. But the most I ever made as an employee was $18 an hour. And I started trading in 2020. So I never got to actually experience what being an employee and making extremes amount of money from the stock market at the same time actually felt like. And I think God knew exactly what he was doing by introducing trading to me much after I was an employee, because if I was making $6,690 over the past week, I'm not sure what my boss would be able to tell me. My boss probably would have came around and said, hey, Rod, I need you to do this. And I probably would have looked at him like, you talking to me? Like, could you imagine me back at that job in 2017 making $18 an hour, but bringing in nearly $7,000 per week from the stock market? See, God knows what he's doing, and his timing is always perfect. But anyway, shout out to Leho. Keep making that money, man. I know you will, because I've seen your profits and your growth and your gains over the last 6 months. So keep doing what you're doing. And if you know anybody who would like to join the Trader Freedom community and generate consistent and reliable income off the cash that they already have, then tell them about it. The link is below in the description, but not only will they get my exact trades when I enter them, but they'll also get my entire options framework via the Trader Freedom course. They'll have full access to ask me questions at any given time. And lastly, they'll be within a community of other traders who all have the exact same goal as them. So if you know anybody who's still trying to make 2025 their best year yet, send them the link below in the description. But with that, let's get down to business. Now, the option strategy that I use with these two stocks is the wheel strategy. Now, if you're not familiar with the wheel strategy, I will quickly explain it. However, if you are familiar with the wheel strategy, make sure you watch this video till the end, because I will show you a better way to do it that greatly increases your probability of profit. All right, so with the wheel strategy, the first thing you want to do is you want to sell a put. Now, when you sell a put, you are just agreeing to buy shares of a stock at a specific price by a specific date. All right, so a quick example, if ABC stock is currently $100 and we sell a put at $80, we are just agreeing to buy shares of ABC stock at $80 if the stock price were to drop below the $80 mark. Now, because we are selling puts, which is basically like selling insurance, but for stocks, we are collecting premium. All right, when you sell a put, you get paid premium up front, and you keep that premium no matter what happens with the stock price. All right, but if ABC stock were to stay above the $80 mark that we set, then we just keep that money we were paid, and we can do this step over and over and over again and keep collecting premium. However, if ABC stock were to drop below $80 by our expiration date, now we are forced to buy the shares of the stock. All right, but we still keep that premium that we were paid. And the key to this step is to only do this strategy on stocks that you would actually like to purchase anyway. Because if you do that, then it's just a win-win situation. All right, either you get paid to wait around for a stock to drop and it never happens, or you get paid to wait around for a stock to drop and it does happen, and you buy the shares of a company that you really wanted at the price that you really wanted to purchase it at. All right, so that is the selling put portion of the wheel strategy. And then the second part is selling covered calls. All right, so let's assume that the stock that you sold puts on actually dropped. So ABC stock dropped from $100 to somewhere below 80, and you had to purchase the shares of the company at $80. Well, now you can turn around and you can sell a covered call. And now a covered call is just you agreeing to sell the shares that you already own at a specific price. Okay, and again, for doing this step, we get paid to do so. So let's assume ABC stock dropped and it dropped down to like $75. All right, but we agreed to purchase the shares at $80. So we had to purchase the shares at $80, but now we could turn around and sell a covered call at anywhere at or above the level that we paid for the stock. So let's say you turn around and you go ahead and sell a covered call right at $80. Well, now again, you get paid for doing so. And in this situation, if ABC stock stays below $80, then you keep the premium you were paid and you also keep the shares of the stock that you own. However, if ABC stock were to go above $80, well, you still keep the premium you were paid, but now you'll be forced to sell those shares that you have. And so now you've got paid a bunch of money and now you're back at step one and you can go ahead and start selling puts again and selling covered calls. And that is why it's called the wheel strategy, because you keep doing those two steps over and over and over again. All right, but now that we know that, let's look at the two stocks that I'm referring to. The first stock that I'm referring to is ticker symbol TQQQ. And TQQQ is UltraPro's version of a triple leveraged ETF for the NASDAQ 100. And so this stock moves very similar to ticker symbol QQQ. However, because it is triple leveraged, that means it moves 3 times the move that the sector moves every single day. All right, so if QQQ is up 1% for the day, then TQQQ will look to move up 3% for the day. And the same works in reverse. If QQQ was down 1% for the day, then TQQQ will look to be down 3% for the day. All right, and I can show you that here. So we can see that TQQQ is up 4.22% right now. But if we look at QQQQ, well, we can see it is up about 1.43% as of right now. So TQQQ is up about 3 times more than QQQ. All right, so we have a pretty big green day in the sector for today. And we within the community made a bunch of trades on Friday because it was a nice red day. And so we are already seeing huge profits from that. Well, your next question is probably, well, why do you like trading leveraged ETFs? Well, there's a few reasons. The first reason is the stock price. So if we look at TQQQ, we can see that it's around $76 currently. And for most people, it's a lot more feasible to sell puts on a stock that's at a cheaper price, because if you are forced to buy 100 shares of it, then it would require a lot less buying power. Because if we look at a comparison again, so again, TQQQ is around $76. However, QQQQ is $534. All right, so buying 100 shares of QQQ would require a lot more money. But also the second reason why I like using leveraged ETFs is because the more volatile a stock is, the higher the premiums will be. And so because TQQQ moves about 3 times more than the sector that it follows, comparatively, the premium should be about 3 times more. All right, so it takes a lot less buying power in order to trade it, and we also get about 3 times the premium. So those are the reasons that I like using TQQQ, or just leveraged ETFs in general. All right, and if we look at some of the data down here, we can see as far as assets under management, this is not a small ETF. It has $28 billion of assets under management. And of course, it does have a management fee of 0.86%. However, that only comes into effect after you are actually forced to purchase the shares of the stock. All right, and the amount of return that we get from trading this stock is so much more than that 0.86%, I don't even worry about it. But then if we also look at implied volatility, which is a big factor when calculating options premiums, we can see that TQQQ is about 52% for the implied volatility. And comparatively, if we look at QQQ, we can see that it is 17.95%. So again, you're getting about 3 times the premium that you would if you were just trading QQQ. All right, now if we look at the stocks that are within TQQQ, you will see it's all the same stocks that you will find in the NASDAQ 100. So if we scroll down, we see Microsoft, Nvidia, Apple, Amazon, Broadcom, Meta, Netflix, Tesla, Costco, etc., etc. So you'll see pretty much the exact same companies. But the second stock I was referring to was UPRO, ticker symbol UPRO. And so this is pretty much the same as TQQQ. However, it's a leveraged ETF that follows the S&P 500. So it looks to move about 3 times the amount as any long ETF that follows the S&P 500, such as ticker symbol SPY. And if we do the exact same comparison, if we look at UPRO, we can see it's up 3.45% today. And then if we take a look at SPY, we can see that SPY is up 1.15% today. All right, so UPRO is about 3 times the move of any other long ETF that just follows the S&P 500. But taking a look at UPRO, we can see assets under management is about 3.9 billion, so not as much as TQQQ. And then for the management fee, it is 0.91%. However, just like I said with TQQQ, my rate of return trading the stock is so much more than what that percentage is, so I don't even pay attention to it. And also, we don't start getting charged that percentage until after we actually own the shares of the stock. All right, but let's head on over to Thinkorswim and look at a potential trade for both of these stocks. But real quick, let's take a look at the expected move so we can have that data and use it when selecting our strike price. Now, the first thing we need to do is select an expiration date, and I typically go up to 45 days out. Now, you don't need to do 4 to 5 days out, it's just up to. So if you want to select 30, you want to select 20, 10, it doesn't matter. I just do a maximum of 45 days out. But since we're looking at monthly income, let's take a look at this date that is 32 days out from now. And we can see UPRO's current price at $85. And the maximum expected move from now until then is a $9.10 move, which will be about a 10.64% move. Now, on the lower price, that would put us around $76. So that is the price that we want to pay attention to. All right, so we have our price for UPRO, but now let's take a look at TQQQ. All right, then same thing, we'll do the exact same expiration date. We can see the price is currently $76. The expected move is around $8.09, which is about 10.64% as well. And then on the lower end, it has us at $67.97. And so just to make things easier, we'll say that is $68. But now that we have our two price points for our two different stocks, let's go ahead and head over to Thinkorswim and look at a potential trade. All right, so now we are in Thinkorswim and I have TQQQ's options chain pulled up. So the first thing we need to do is go to the exact same expiration date that we're looking at, which was the 32 days out from now. Now, we're over here on the put side, which is always on the right. Now, if we recall, our expected move was $68. And so the expected move is just the maximum move that the options market currently has priced in for a specific stock by a specific date. And it's saying that the largest move that is priced in currently for this stock would be at a low end of $68. And we can see at the strike of $68, that would put us at a premium of about $2.10 to $2.13. And so with options, everything is times by 100. So we will receive anywhere between $210 to $213 per contract for selling these puts right here, right now. Now, if we take a look at the delta is this column here, but the delta just aims to show how much an options premium will move per a $1 move in the underlying stock's price. However, how I look at delta is the probability of the event occurring. So at a 0.24 delta, that's telling me there's about a 24% chance that TQQQ stock price, which is currently at $76, will drop down to $68 by this expiration date. All right, so in other words, we would have about a 76% probability of profit. Now, when it comes to delta, I typically stay below a delta of 0.20. However, when I'm trading market-based ETFs such as TQQQ, I am fine with getting a little bit more aggressive. So we will go ahead and we will go with that $68 strike. And if we wanted to place this trade, all we need to do is come over here and select the bid price, and our brokerage will automatically load our ticket for us. So we can see it says sell, and then we need to select our amount of contracts. Now, this is totally up to you and your account size. But how I like to do it is I like to kind of dollar cost average into the trade. So I'll sell puts every single day sometimes. But let's say for the purposes of this trade and for today, we are going to do 5 contracts. All right. So I'm just going to put the number 5 here. And we can see at the mid price right now, we'll get about $212. So I'll go ahead and select that. And if we wanted to go ahead and place the trade, we go ahead and hit review. However, let's go down to the P&L chart. Now we can see these green dots right here are where TQQQ stock price is currently. And if we look at the number there at the top left, that will show you how much the contracts will be worth on expiration date. Now, we did 5 contracts and received $212 for each. And so that is $1,060 that we receive right here, right now for putting on this trade. And we can see if the stock price goes up, then we just make that $1,060 that we received and we go about our day. If the stock price stays about the same, we just keep that $1,060. If the stock price goes down, we just keep that $1,060. However, if the stock price were to drop below our $68 strike, then we start to make less and less money, as you can see here. And then if the stock price were to drop even further, then this would start to become a losing trade. However, you are fine with that because you are fine with purchasing the shares of a stock that you selected at the strike price that you selected. So that's the correct mindset to use when going about it. Do not sell puts on a stock that you would not like to own at a price that you would not like to own it at. All right, can you make money doing that? Absolutely you can. But the amount of unneeded stress that you get because you're scared of a stock price fluctuating just a little bit, it's not even worth it. Just use this strategy on stocks that you would really like to own at the price that you would really like to own them at. Okay, and now with that being said, remember when we are selling puts, we are agreeing to buy the shares of the stock. And every contract is worth 100 shares. So one, do make sure that you do have the cash available to purchase 100 shares of said stock if the stock price were to drop down. And if you do not actually want to purchase the shares, then what I used to do is I would do a 3x premium stop loss. Okay, so if the trade were to go against me and the premiums got to 3x the amount I received, then my brokerage will automatically stop me out. And I would just take my losses for that trade and I would go about my day and focus on my other trades. However, the much better way to do it is just to do the strategy on a stock that you would like to purchase at the price that you would like to purchase it at. All right, and that absolutely helps me sleep like a baby, because if the stock price goes up, I do not care. If the stock price goes down, I do not care. Okay, but again, like I said, this is just how much we did for this day. And then I would probably sell more puts the next day and then the next day. And on most months, I can generate well into the 5 figures just using these 2 stocks. All right, but that was the selling put side of it. Now let's go ahead and talk about the covered call side of it. So let's head on back to the options chain and put on a trade for a covered call. All right, so now we're here at the options chain and the call side is always over here on the left. Now, when it comes to a covered call, you can set your strike price at anywhere near your cost basis or higher in order to get profits. All right, so in this situation, since TQQQ is currently $75, let's assume that we had previously sold puts at $80 and we were assigned the shares at $80. So now we can sell a covered call at anywhere at $80 or higher. And for me, I always like the more guaranteed income. So I'll usually go somewhere around my cost basis. So let's go ahead and sell our covered calls right at $80. And we can see here that the $80 strike will pay us anywhere between $276 to $288 right here, right now. And so let's go ahead and select the bid price and it loads our ticket for us. And then we can go ahead and select the amount of contracts again. So let's assume we had 5 just like before. And right now the mid price is $280. So I'll go ahead and select that. And 280 times 5 would be $1,400 that we would receive right here, right now, if we were putting on this trade. And remember, a covered call is just you agreeing to sell your shares at a specific price. So if TQQQ were to go above $80, then we still keep the premium we were paid. However, now we are forced to sell the shares that we have and we can start the wheel strategy all over again. However, if TQQQ were to stay below $80, then we keep that premium we were paid and we also still get to keep our shares, and then we can do this part of the strategy over and over and over again. And so that is the amazing power of using the wheel strategy on tickers like TQQQ, and we can go ahead and take a look at UPRO as well. All right, so here we are at the options chain for UPRO, and I'll go ahead and select the exact same expiration date that was 32 days out from now. And now, because UPRO follows the S&P 500 and it has 500 companies within it, typically the S&P 500 is a little less volatile than the NASDAQ 100. So you'll find that the premiums for UPRO are going to be a little less than TQQQ because it doesn't move as much. But if we scroll down a little further, if we recall, the expected move was about $76 for UPRO. And so we can see at the $76 mark, that will pay us anywhere between $185 to $195 per contract with a delta of just 0.22. So although the premiums are a little less than TQQQ, you get 1 less volatility and 2, that is still an amazing return at almost 3% for the month. And if you can consistently do that, then you'll beat the market pretty much every single year. But again, remember, this is just the put selling side. Once we actually get assigned the shares, it gets even more fun because we get to make even more money when we are selling our covered calls. Well, ladies and gentlemen, that is it for today. I hope you learned a ton and I hope you have a blessed day. Again, if you know anybody who would like to join the Trader Freedom community and generate income off the cash that they already have, then tell them about it. The link is below in the description. But that is it for this video. I will see you guys on the next one. Peace!